Hi, and welcome back to CPE's Investment Matters. I'm Paul Rosta. My guest for this episode is really on the go these days. Dan Michaels is managing partner of Stockdale Capital Partners, and he's leading a major growth initiative for the LA-based private investor. Recent highlights include the closing of a $700 million opportunity fund, the firm's first multifamily investment, and new offices in Dallas and New York City. On top of all that, the company is expanding its ranks by recruiting senior professionals from other companies. Right before he was about to head back to the road recently, Michael slowed down just long enough to talk with me about the firm's strategy and how he sees the market. He told me that the current climate offers the best opportunity amid dislocation since the great financial crisis. As he put it, we are pressing to make the bet that we are going to be one of the winners. If you enjoy the Investment Matters podcast, I hope you'll check out CPE's Capital Markets newsletter, our free twice monthly roundup of the latest trends, analysis, and data in commercial real estate investment. It's easy to subscribe. Just go to commercialsearch.com/news/subscriptions. Again, that's commercialsearch.com/news/subscriptions. And now, here's my conversation with Dan Michaels. Dan Michaels, welcome to Investment Matters. It's really nice to be with you today, and thanks for making the time.
Nice. Thank you.
Speaking of which, I've gotten the impression that you have been dashing around the world even more lately than you usually do, which in your case, I think is saying something. And that's because Stockdale is in the midst of a major growth initiative. Just to set the stage a little bit, you've been making some big expansion efforts to the team, bringing senior executives on board. You've been opening offices. So could you tell us a little bit more about some of these initiatives and how they fit into Stockdale's growth strategy?
Yeah, absolutely. Well, obviously, pretty interesting times in commercial real estate over these past 5 years. I don't think you've ever had a moment where you've had multitudes of black swans year after year, or it almost feels month after month. The firm was started post GFC as a distressed turnaround investor, vertically integrated owner operator, where we could fund manage, asset manage, and property manage all of our assets. And we deliberately kept a very flexible mandate to go out and find the best risk-adjusted returns across all asset classes. And it felt like as we grew, the market got tighter. And in 17 and 18, it was almost like price to perfection, and we couldn't find much to do. Well, lo and behold, that was about the time we finished up our first discretionary commingled fund. And of course, we all know what's happened, post 18 with, everything from COVID to work from home, from Ukraine and inflation and rates and on and on and on. And so we find ourselves in a moment as a distressed turnaround investor into one of the most, I don't know if fruitful is probably the wrong word, but the most prolific investment opportunity amongst dislocation that we've seen really, really since the GFC. And in that has been an incredibly rich environment to excel through what is a lot of pain that is coming through the commercial real estate industry, particularly in the private equity industry, where the issues of liquidity have compounded the ability to fundraise. As the person that co-founded the firm with my partners over 50 and have done all of the, majority of, if not all of the hiring and fundraising, it has been an incredibly rich and one of the greatest talent buying opportunities because so many funds are out of their, promote or carried interest. There's a slowdown or a stagnation of fundraising, and a lot of executives that, frankly, we weren't even able to speak with many years ago. We are now actively engaged with and hiring. And so not only is it a very rich time to have capital to go out and pursue transactions at interesting valuations, it's also an opportunity to go out and grab talent to build a best-in-class organization. And we have been doing both. very deliberately but aggressively, and doing it across asset classes across the US. And so this is in my time, you don't have many moments in real estate where this much dislocation has occurred for this long, and it's shaking loose real opportunities that I am waking up every morning excited about trying to seize upon.
Well, let's zero in on a couple of these areas that Stockdale has been focusing on. One recent milestone is the debut of your multifamily platform, which you announced last fall. And you've already made a number of high-profile acquisitions, just to name a few, an upscale community in Dallas and a couple of Metro Phoenix deals that both traded for north of 100 million. Why did the company decide it's the right time to add multifamily investment to the mix? And how does it align again with Stockdale's larger strategy?
Yeah, that's a good question. So, one thing that is interesting is for many years we tracked multifamily, and for many years we tried to acquire multifamily, and for many years we failed because we just could not wrap our hands around the math of trying to buy something at a sub four cap, praying that rental growth occurred in double digits and that expenses stay muted to flat. And our question was always, well, if any one of those things, including interest rates, happen to go the wrong way, that entire model tips over and you're not left with a margin of safety. And so, for the first time in a decade of looking at transactions, and this I think speaks to our platform where you have allocators and then you have operators, and a lot of operators are single asset class operators. So if you're the multifamily guy, you only do multifamily and you only have to do multifamily no matter what. Well, there's some times when that just doesn't make sense. If you're the office guy and only you can do is office, there may just be times when office doesn't offer the best risk-adjusted returns. And so our ability to be a fund manager, in essence, the allocator and the operator, but come across all asset classes, gives us the opportunities to dip and dive in and out of asset classes. And so here comes multifamily, where you have, billions upon billions of loans in the ZIRP era, zero interest rate period area, that have now tipped over with skyrocketing pricing and a skyrocketing supply and kind of a perfect storm of oversupply, increased expenses, be it insurance, clearly financing, up against, muted to declining rental rate growth. And it's filled with a majority of capital that is not necessarily as institutional as other asset classes. So I think it's something like 60 or 70% is owned or was recently acquired during the zero interest rate period by syndicators. So what does that mean? That means somebody that pulls together capital, generally not as institutional as some, let's say, a Greystar or Blackstone, and they don't have the same level of liquidity or balance sheet to manage through rough waters. And so what you've seen is an incredible opportunity to buy Class A, brand new multifamily in markets of growth at significant discounts to replacement cost, where you may have to hold these things through a period of tumult as rates hopefully over time decline, expenses start to subside, but most importantly, rental rate growth increases. And there's just folks that when it comes to time to refinance or transact, they just do not have the same ability to hold on. And so those three assets were all scenarios with either syndicators or developers who had a liquidity dislocation and had to sell. And our ability to step in, close all cash, know those markets, and move swiftly allowed us to garner those opportunities that will drive significant returns. But that's occurring across multifamily, and that is an incredibly interesting entry point for us to come in and say, okay, now is the time to start creating a portfolio of great opportunities in multifamily at a reset basis.
Well, against the backdrop of today's multifamily market landscape, are there any particular kinds of assets that fit particularly well in your strategy? And any kinds of locations, you mentioned high growth markets, but do you have a for instance or two of the kind of situations that are most attractive to you right now in multifamily?
Yeah, we really stepped back and we studied the market nationally and we said, look, where is there the great and really literally ranked and filed where each one of these markets are, not only by MSA, but by submarket and honestly, sometimes even micro location of the supply and the return through concessions of rental rate growth. And so you have this kind of like wheel where certain markets are starting to get through their supply and actually return to rent recovery, and other ones are still working through their supply. And so we actually went in and we said, let's pick the 4 or 5 markets that we have the most conviction in that start to exhibit obviously all of the qualifications of in-migration and, per capita wealth, access to retail and schools, but also interesting supply demand imbalances. And now you don't always find in that analysis, macro analysis, the one developer that just happens to have run out of time and money where you can buy something cheap. But we are circling above, constantly trying to troll the waters where we can finally pick off the situation in a submarket like a Scottsdale, Arizona, like a Dallas. And it's not just Scottsdale. Like we focused in on the specific market in North Scottsdale called Kierland, a submarket named Chandler, and then we have our eyes on other markets that are recovering, be it in Nashville, or Denver, or even further off in Austin. And we're starting to constantly debate and discuss how we want to enter those markets. And then, of course, because we do all asset classes, you got to understand, Paul, like we're looking at what's happening with the hospital systems, what's happening with the access to retail, who are the new tenants moving into the retail. And so one of the situations was one of the things we bought was a multifamily building where we almost bought the mall at one point across the street. And so we knew what was happening with that mall and the tenancy and how that access to retail drives multifamily and resident demand. Because we do office and we follow the corporate demand, we then can say, well, hold on, we know this group's coming in for this type of office tenancy, hiring these people, and we can start to read the mosaic of what's happening as these submarkets evolve beyond the supply demand dynamics of the multifamily.
Yeah, and your approach really does show the advantages of having a diversified portfolio, right? Because you could say if you could that example where you almost bought a retail mall, but then you came across this opportunity in the multifamily property that was right next door.
Correct, and leverage that information flow of what had we had done previously on the retail opportunity to understand how to improve our position with regards to this multifamily investment, as an example.
Well, let's talk a little bit, if we could, about some of the other asset categories that you're active in, which range from not only the ones that you've cited, but also medical office, boutique hotels, creative office, and as we've just discussed, multifamily. Where do you see the most attractive opportunities for investment and growth among these different asset categories? Is there anything that's standing out right now to you?
Yeah, it's interesting. We closed our second fund last year. And fortunately, we raised 50% more capital for our second fund than our first fund. And in total, we've raised so far about 800 million of equity in that fund. And it allowed us to step back with this much dislocation and say, well, where do we want to put our dollars? And when you're sitting there with that kind of liquidity, in a lot of circumstances, excluding the big guys like a Blackstone, but in a lot of circumstances where people didn't have that same fundraising success, it gives us, I don't want to say our pick of the litter, but it gives us a chance to step back and say, okay, where is the best risk adjusted return? And what submarkets or asset classes or sub asset classes are exhibiting the best risk adjusted return in terms of recovery? And so the 3 or 4 we've really focused on, besides, those micro locations for Class A office, is outpatient medical office, which is obviously boosted by, aging population, one of the great macro trends, and lifestyle retail, which is, both proven to be both COVID resistant, as well as, in our view, AI resistant, where people want to have an experience in food and beverage, lifestyle, experiences, be it fitness, grocer or otherwise. And so we've really focused on, those 3 things. And then we happen to also do credit. And so we've looked at other circumstances where we may not be as interested on the equity side, be it an office or a life science asset, or even certain hospitality assets, and said, is there a better risk-adjusted return coming through the debt? And so, for us, we've been able to dip and dive and say, we like medical, we like we like retail, and let's define those further by market or sub asset class. And then let's also look at some credit trades where we can also earn risk-adjusted returns, albeit in a different point of the cap stack, that are still attractive.
I wanted to ask you about a property that CPE reported on a few months ago, the shops at Northfield. And here's a little background for our audience just to set the stage. This is an upscale lifestyle center in Denver. It's about 1 million square feet, 1.1 million square feet, and it's called the most visited retail property of its kind in Denver. In the 5 years since Stockdale acquired it, you've re-tenanted former anchor boxes to Wayfair and Lifetime. The fitness change, you've secured entitlements for 1,200 residential units. And as CPE reported back in February, you recently recapitalized the property in collaboration with UBS. With all that in mind, could you tell us about the vision for the shops at Northfield and what that says about not only your strategy, but also opportunity in this sector?
Yeah, listen, what's interesting about retail, as I'm sure some or most may know at this point, is that there has been zero point zero new development of retail over the past decade, post kind of e-commerce boom. And so what you're seeing is, despite all the fears, is incredible supply-demand imbalances where good centers are getting better, but the product is still stuck in the 90s because no one's built anything since then. And so you have these open air centers built in the 90s, for the most part stuck in the 90s in terms of design, in some respects, the tenancy as well, in markets that have continued to evolve. So when this was built on the former Stapleton Airport in Denver, and none of the housing existed. It was an old Forest Cities project that was acquired by a pension fund in Australia. And all around it, Brookfield was building housing, but it hadn't yet fully formed out. Well, it turns out this pension fund had some issues in owning it. They couldn't do the leasing. It sat with, the J.C. Penney's box and the Macy's box, which had largely been abandoned. And what you looked around, you actually drove around is, well, gosh, this community deserves a better retail experience. And by the way, if you went throughout the major MSAs in the US, you may have one where a Macerich or Simon put a bunch of money into, or maybe one of the private equity retail guys bought and turned around. But for the most part, it's pretty old stock. And they're generally weighed down by boxes that have been abandoned by a J.C. Penney or a Macy's or whatever. And so that's right for someone like us to come in who, again, is looking at, well, gosh, this medical office is growing, this housing is growing. We can see beds and heads following. We need the retail application. And so we went in and bought that in 2021. And you're right, we bought the Macy's box. And Macy's was retrenching from the market. We put Wayfair in there. We had the J.C. Penney's. We put Lifetime Fitness. We signed a whole host of tenancies, and what we brought was a cohesive merchandise plan that was taken out of the 90s into today. That was food and beverage oriented. We brought in a Nike. We brought in a P.F. Chang's, amongst others. And really started to cultivate a community. We have now a pretty significant capital program to bring in a community and through the center of the project, which is occurring right now. What we saw was people wanted to be there, but their retailers didn't speak to the community. And they were almost showing up despite the tenancy and despite the lack of investment from the prior owners. And so we thought, well, there's more housing coming and people want to be outdoors in Denver and they're still showing up here anyways. Let's actually put some dollars into this and give the community what they need. And so lo and behold, that was our third or fourth investment in our first fund. And so we actually recapitalized that transaction out of our fund with the LP you mentioned to take it kind of into its next phase to deliver these new boxes, these new tenants, finish out the capital program, and it will align beautifully with all of the continued development. On top of that, as you mentioned, we took 14 acres and entitled that for multifamily because adding more housing and more community and more density only helps the retail. And so that's where the mixed use execution on our behalf starts to bring alpha, because we can bring the oversight of the retail and the F&B and the CapEx plus the multifamily. We can read what's happening across housing and medical and other industries and kind of understand the opportunity to create value, which is what we did here. And we're doing that, by the way, in Thousand Oaks, Southern California, Los Angeles. And we're about to announce something here in the next few weeks to the same degree.
And so that just for our audience, you referred to Thousand Oaks, which is a little bit north of the greater LA area.
Correct. And that was an 80-acre mall owned by Macerich, and they had decided they did not want to invest in it anymore, and they were moving on. And what was always surprising to me was that I would sit there before we bought it, and the mall clearly had not been invested in a while, and it was packed, and there was kids and parents and friends, and it's like, what are these people showing up for? Half this is like temp space, and what it kept showing me, because there was like 7 million people still going to the mall despite it not having seen a dollar in a long time, was people wanted a community. People wanted to gather. People wanted to be here irrespective almost of what it was offering. And so we thought, God forbid you actually put in real tenancy and real dollars and real food and beverage and took it out of the 90s. And so we brought in some incredible executives to continue the impact and turnaround of that asset. We've got a bunch of names we're about to announce, and that's going to be an incredible asset for that. And Thousand Oaks is a wonderful place, and it deserves something best in class, which was what this will be. But thus the opportunity for us to step in and turn it around and bring our operating expertise to the retail.
Yeah, I'm sure you were all imagining what it could look like with a
A
little
little love.
investment, right?
Yeah. Little love.
Little TLC, right?
Yeah.
Hi, Paul Rosta here. I hope you're enjoying this episode of Investment Matters. For more great investment and finance content, subscribe to the CPE Capital Markets newsletter. Just go to commercialsearch.com/news/subscriptions and subscribe today. And now here's the second part of my conversation with Dan Michaels. Well, Dan, I'd like to turn to your own professional journey. Now, you have a degree in finance and accounting from the Wharton School, but when did real estate get on your radar? Were you interested in the business from the get-go? Was it an evolution? How did all that come about?
Yeah, so yeah, I did. I went to Wharton undergraduate, which when you're studying finance and reading Barbarians at the Gate at 18, starts to distort your brain a bit. But when 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 Henry Kravis becomes your hero, as opposed to some philosopher or doctor or whatever, but I had always been fascinated by finance. My first job was at Morgan Stanley in the M&A department, working for one of the most talented bankers there was, a gentleman named Paul Taubman, who's since gone on to create a firm called PJT. I think one of the only men, when they showed the league tables, it was like Goldman, like City, and then it was like Paul Taubman. He like had his own name because he was still advising when he started his own firm, or before he actually started his own firm. But it was really an incredible opportunity to learn that world. And then of course went on to work at the Carlyle Group, and you can't not be fascinated with that type of organization and the history of it. And of course, when you come out of Wharton, everyone works as a fund or has some relation to a fund. And so you were hearing the stories of other people at Blackstone or KKR or whatever. And by the way, like this was Blackstone 25 years ago. But I mean, I think when I was at Carlyle, I think we managed like $16 billion, not me, but David and the rest of the team. Um, but that seemed like the biggest number in the world. It's like, how could you possibly get bigger than $16 billion? You know, it's just like, to me, it was like that was the top. And of course, we've all seen how these organizations have grown and scaled to hundreds of billions of dollars. But I just was fascinated by the opportunity to extract value in investments. I saw it on the corporate side, I saw it on the real estate side, I saw it on the public side, where people that were dedicated to driving value woke up every day thinking about how to turn around a company or a piece of real estate or drive better execution through, a public company, be it as an activist or not. And so that's just been my whole world. And I always joke, like, some people want to go be rock stars or tennis pros or doctors. Like, I always wanted to start a private equity firm. I just always, I don't know, something about walking into like the Carlisle offices in DC or 9 West 57th when KKR was there. It was just like hollowed ground. And these guys were doing, they were making magic. It was like they're buying, it was these corporate raiders and turning things around. And I just, for some reason, I think in retrospect is a little weird. It's just a little crazy, but I just always was fascinated with it. And I didn't know exactly how it was going to turn out. But when the GFC hit, I actually left before uh, I could kind of see the writing on the wall, and I was like, this is going to be one of the greatest buying opportunities. And I actually went out at the like ripe age of like whatever, 32 and 33, and started to go look for partners or a family office, like anybody that would listen to try to shake the trees and say, like, I'll run through walls to figure out whatever that investment opportunity is. And so I went out proactively with an obscene amount of confidence relative to now realizing how hard it is. And it was always fascinating to me because, like, I had this conversation about real estate. The biggest owner of real estate was a former Lehman banker. And, Steve Schwartzman wasn't a real estate guy, but he knew how to raise capital, he knew how to manage risk, he knew how to hire good talent, and he knew how to see value. And I'm always fascinated by that because, of course, Blackstone's an incredible organization with some of the most talented people in the world. But it wasn't like they didn't grow up as real estate guys. They knew how to build a real estate business. And so I always challenged myself to go out and say, well, look, understand how to find value no matter what the industry or sector is and how to drive results. And so I went out to go build Stockdale. It was something that hell and high water I was going to do. And met my partners and we said, look, we're going to be an operator. We're going to be flexible. We're going to start doing deals in an allocator operator model. We're then going to grow that into programmatic joint ventures. We're then going to go control the capital and go raise a fund. And we have followed everything we said we're going to do. And lo and behold, we're now whatever $3 billion or whatever of assets, which is still a proverbial drop in the bucket relative to the big guys, but we have garnered incredible momentum in the talent game. And so the whole thing was let's go out and hire great operational talent alongside great analytical talent from some of the best in class firms and be an employer of choice and really, frankly, take market share. As opposed to giving your money to an allocator to give to us, they just give it to us. And there's no double promote, there's no double fees, and we can control the assets directly ourselves.
Well, could you give us your take on the trends that are shaping investment and the capital markets opportunities today? What's on your radar right now, and what trends are you kind of keeping an eye on?
Yeah. Well, there's some big macro dislocations, as I've said, around liquidity, right? I mean, there's never been a moment where there's been such a massive illiquidity, particularly in private markets. I mean, obviously you've had public markets at sky high valuations driven by AI, but for the most part, real estate's been in a recession. And that's impacted a significant amount of the real estate community, particularly around private equity in certain sectors, be it office or life science, et cetera. And so, I think there's just a major theme of dislocation. firms shutting down, firms winding down, firms slowing down because they can't raise the capital, bankruptcies, assets going back to lenders. And in that is a mix of opportunity that if you are able to, leads to some credible, what I think is some credible investments, both in talent and assets. And now is the time to capitalize on them. And so what we're looking at is not only assets that have fallen apart, but firms that are falling apart. And where can we step in to take over potential platforms, potential operating companies? When you have this kind of a seismic shift, you got to step back and say, where do I want to be and how do I grow? And, there hasn't been, and by the way, when you go to Wharton undergraduate, everybody is in finance for better or worse. And so I've seen a lot of good stories. I've seen a lot of bad stories of firms and talented executives who, despite their history and expertise, just haven't been able to survive. And so I think because I've spent about a third of my time in building this organization over the past 15 years interviewing people, I've really gotten a good sense of how firms have evolved, good cultures, bad cultures, what firms are doing well, not well. And I say all that because one of the big themes is the ability to garner great talent because there's such dislocation and then marrying up the capital to go out and do the deals. And so it isn't necessary. I mean, there are obviously themes within any one asset class or certain geographies, but the seismic fallout of real estate when you have a quintupling of interest rates with these seismic shifts of wars and pandemics is going to create winners and losers. That's just the bottom line. There's been too much disruption, and we are pressing to make the bet that we're going to be one of the winners.
Well, then now we come to one of my favorite segments of Investment Matters, which we like to call Executives Off the Clock. None of us can work 24/7, even though it seems like we sure try sometimes. And goodness knows you yourself are on the road constantly, a couple hundred days a year. But when you do have a chance to take a breather, is there anything in particular that you like to do just for a change of pace?
Well, I have to admit, I haven't had much free time to be able to do it. And as they say, when you love what you do, it's not necessarily a job. And so, but I'll tell you one thing where there has been a combination of kind of the work and I don't want to say the play, but this job, because we've not only been able to look at assets across the US, but garner capital relationships globally, the ability to travel and go out and see different geographies and cultures, understand investment themes and concerns from people in Copenhagen and Tokyo and Dubai and Sydney. Like you are afforded a global outlook, not only on the investment themes and priorities, but also what's happening in those communities. And so while it's not necessarily reading a book, the ability to go out and actually combine a little bit of that travel with building our business has been fascinating. Full disclosure, I have a wife and two very young kids, so they keep me busy in the moments that I'm not trying to build the business. And every once in a while, I try to go see a show, jazz music or do some cooking. But to be honest with you, I've been pretty single-minded in growing this business and the ability to go out and travel the world and build those capital relationships, which are the absolute most important thing to us beyond our employees, has been honestly part of the joy in creating Stockdale. And there's moments here or there. Well, I'll get to go see a museum in Zurich or see a baseball game in Tokyo, and that's always an interesting facet of being able to kind of grow my global exposure and perspective, which I've enjoyed.
Well, Dan, I really appreciate your taking the time to sit down and chat a little bit since I know you're constantly on the run, but I'm glad we got together. And thanks very much for sharing what's going on in your shop and also just your take on what's happening out there in the market.
Appreciate it, Paul. Thank you very much. Look forward to continuing to dialogue with you and listening to your podcast.
You bet. Thanks, Dan. That was my conversation with Dan Michaels of Stockdale Capital Partners. You'll find more CPE podcasts on our website, commercialsearch.com, And be sure to follow us on Spotify, Apple Podcasts, and YouTube. Until next time, thanks for listening and be well.